Okay. All right, so let's, if you go to the questions at the end of the third learning objective in section 3, this is where we left off. We're going to go through a couple of questions in this learning objective. Then we're going to move on and just say a little bit about the adjusting process, and then we're going to move into chapter 4. At the end of the day, I'll just give you a little bit of an idea of what you should be focusing on for the exam. I'll actually put some things on Blackboard for you so that you have a better idea of what to focus on. But certainly, let me just give you at least an overview. The exam will focus on the first 3 chapters predominantly, very little on chapter 4. So it'll focus on journal entries, T accounts, and adjusting entries, and the accounting equations. So those are your 4 items. That would be mechanically, but theoretically you have to understand and think about those multiple choice questions that we did on the clickers, as well as any of the homework that you may have seen. So you have to know something about going concern, you'd have to know something about conservatism. Yeah. Oh, the form? Yeah, the forms are due October 1. Okay? All right, so let's get to this question. Yeah, I will. I'm going to do that at the end. Yeah. Okay, let's get to this first question. All right, so here's a perfect example, although this would be in multiple choice form. This is a perfect example of an exam question. So I'm going to ask you about an adjusting entry, and this is the way I would do it. So let's see what you can come up with in a minute. And by the way, there are 40 questions, so the average is 2 minutes per question. So let's see if you can do this one in a minute. All right, so we have Ogden Company with $2,000 of supplies on hand. During January, they purchased 4,000 more. At the end of the month, they counted their supplies with 1,000 left, and we want to know if the adjusting entry would be a debit to supplies expense. Okay, so the clock's not showing up for some reason, but the clock is there, but it's not showing up. Okay. Okay. All right, so 82% say it is true, and that is the correct answer. So you would have a debit to hey, what happened? Ah. It's a malfunction. There we go. All right. All right. But now the most important thing is to go. You know, if you to say it's true, do you know why? Anyone? All right. Okay. All right. So you started with let's do this together. All right. And I'll see if I can get this. Okay. All right. So if you looked at the T account, okay, so the office supplies would have a beginning balance of how much? 2,000. Oh yeah, how about that? There we go. Okay, so now you purchased what? Purchased what? 4,000? Okay. All right, so at this point, you have a balance. At this point, you're looking at a balance of 6,000. All right, so what happened in this example? They came up and they counted the actual supplies that they had left. So how much was left? 1,000. All right, so again, we're explaining this during office hours today. If you know where you are and where you want to be, you can make the adjustment. So right now you're here at 6,000. The ending balance is 1,000. So you know that you must have used 5,000. So you used up 5. And then what would be the adjusting journal entry in this case? You would have to debit supplies expense and then credit the office supplies. All right, so that would be for the 5,000. So that would be the adjusting entry that you would need to make. So you have to analyze, you have to know where you are, what my balance is at this point, what's the correct ending balance, and then how do I make that adjustment. Does anyone have any questions on this? Because I want to make sure, I'm going to go through one more, but this is really the essence of this chapter, and that's the type of question that you might see. I would give you like 4 choices. That would be one. And then there'd be 3 other choices, journal entries, and you'd have to select the correct one. No, all multiple choice. So multiple choice with different journal entries that you'd have to select. Yep.
Do adjusting entries always have to contain an expense account?
I'm sorry?
Do adjusting entries always have to contain an expense account?
Yeah, okay. The question is, are adjusting entries always going to involve an expense account? And the answer is, depending on the entry. In this case, yes. It's going to involve one asset and one liability, or I'm sorry, one balance sheet, I should say, and one income statement account. So the adjusting entries always include one balance sheet account and one income statement account, except for what balance sheet account? Cash. Adjusting entries never involve cash. So if you're still not sure of what you're doing, never select an adjusting entry with cash in it. Just to be sure, you can't have cash. Okay. All right. Just want to do one more. All right, so this one, going to do one more, then we're going to move on. We have a company, it's a magazine company selling subscriptions in advance. So they collected 480 of subscriptions on May 31st, and it's for a 1-year subscription or for 12 months. The company uses the accrual method, and what is the subscription revenue for or at December, essentially, when they report in December. So you would have to come up with the revenue that they're going to report from the end of May or June 1st through December. All right, so let's just see. I don't know if this thing is this may not be working right, so just click in and then we'll figure it out. Hope my watch is running. You got about 10 seconds. Okay. All right. All right, so that is the correct answer. The answer is D. All right, so first of all, how do you get that? Well, what you would have to do, by the way, this is the question you see there is, I'm glad everybody's getting it right, is a prototype type of question that we would ask for computations. So it's very, very similar, and there's a lot of theory as well. You know, you have to, again, know about the cost concept, et cetera. But again, this would be very, very similar. So in this case, you come up with $280 per month. What's the first thing you have to do? Anybody? Good. Right? You have to find out the monthly rate. So in this case, you'd have and that comes out to 40, right? All right, how many months? This is the big problem. 7, right. So if you can't count months, that's the problem. So you got 7 months. Like, hey, listen, you know, how many times you're going to start saying May, June, right? You start in May. This is a standard trick in accounting questions. Instead of saying June 1st, which would have been easy, right? Anyway, all right, so you got 7 months earned. And that, of course, is the 280. Okay, so there's the answer. It's 280. Now, let's take this a little bit further. I'm just doing this as a review before we move on. Yeah. Hold it down. I know the police aren't in the back today, but just try to keep it down. Yes. Hold it down, please. Yeah. Yep. No. No. Yeah. So the question is, if you pay for the subscription on May 31st, the subscription begins on June 1. On June 1. So the subscription actually begins on June 1st. So that's what I meant about counting months. I make the same mistake myself. You know, you automatically, see if I said on June 1st, you're going to say, okay, it's 6 months, right? So it's actually easier by saying May. You say May is the 5th month, and out of 12, there's 7 left. Okay. All right, now the more important piece of this is, what's the journal entry? What would be the journal entry they make? Put this back up. What's the journal entry they make to record the subscription? They receive $480 in cash, so they do what? Right. They debit cash, $480. This on May 31st. Okay, so that would be the entry they make at that point. And then, of course, on December 31st, they have to record the amount of revenue that is earned. So what's the entry there? Debit the unearned and credit the service revenue. And that'd be for the 280. All right, so those would be the correct entries. Yes.
Sorry, but can you just do it the other way around?
I don't want to confuse them. Yeah, okay. All right, I'll do that. I'll do that with you. All right. All right. Any questions on this problem? Sorry about that. Yeah. I'm sorry? Oh, it could. Yeah. Service revenue, subscription revenue. Yeah. You could put subscription revenue here as well. Yeah, service revenue is correct as well. The exam would not be designed to test you on, account titles such like as that. It's got to be a revenue though. Okay. If you put sales, it's also correct. All right. So subscription revenue, sales. Yeah. I'm sorry, I can't hear the question. Yeah. Yeah, so you've got unearned revenue is now 200, and that's the remaining 5. Well, I know, but the balance is now 200. You had 480, you earned. Yeah, 200 is unearned, right? Because yeah. So the question is, yeah, and I understand the question. The question is looking at the balance of the unearned. So again, when you make these entries, you have to think about. We go to the unearned revenue account. It had 480. That's the beginning. And then you have the adjustment for the amount you earned. So the balance is 200. And this is for the last 5 months of the next year. 40,000 a month for 5 months in next year. So that's where the 200 comes in. Okay? Yes? No. You don't have to worry about explanations. Again, just make sure that the adjustment process is a huge piece. So I just want to that's why I want to spend a few minutes on this. Any further questions on this? And let me see if I can get this question. Yeah. I'm sorry, could just. Okay, why? Okay. So the question is, why is the adjusting entry for 280 and not for 200? Because you have to get to this balance. So the question, the other way to ask this question, which I could do, I could ask the question like this. I could say, you collected subscriptions for 480, and there are 5 months left. That's 200. I still owe you 200. How many dollars did I earn by providing the publication? I provided you with 7 months, or at 40,000 a month, I provided you with $280,000 worth of subscriptions, or at least the periodical, so that the revenue earned is 280. So we're looking for, in this case, the revenue earned, and by recording the revenue earned and reducing the liability for unearned revenue, we get to that balance. So if you put the 200 in there, the problem would be it would show that you still owed 7 months. So you have to make sure you understand the perspective. And again, as I said, think about what is in the account. Try to make sure you think about what's in the account and what should be there. So there's 480 in the account, but there should be 200 in that account. And you need a 280 adjustment. Yeah, sorry.
So, sometimes for office supplies, sometimes you adjust remaining, sometimes you.
Yeah, it depends on the way the question is asked. So it's going to depend on the way the question is asked. So in this case, the question did not ask you, it did not give you the information to come up with the ending balance like supplies. It makes sense for supplies to not know what's used. So for example, the question here is, why in supplies do you always get the ending balance and you got to work with the ending balance? Well, it makes sense if you think about it from a practical perspective. You're not going to deduct supplies every time we use them. Remember the idea of having, pens and, using oil on a machine. So you wait till the end and you count, and you assume that what is not there has been used. So just a different type of transaction that lends itself to that. All right, so again, anything else on the adjustments? All right. Now the last thing, we're going to move into Chapter 4 in just a second, but the last thing is I just want to make sure that you're clear regarding the fact that at the end of, and there's not much in here, and when we look at the worksheets, we're not going to cover that. We'll cover worksheets in Chapter 4. But what you need to be very clear about is that after adjusting entries are journalized, what happens next? What's the process? You have the adjusting entry. Well, you post them first, right? So the entries have to be journalized and posted to the T accounts, and then those T accounts are used to prepare a trial balance. And that trial balance is called the adjusted trial balance. The adjusted trial balance is what you're going to be using to prepare financial statements. You would not prepare financial statements from an unadjusted trial balance. So the process or the cycle, and we'll see the cycle again. The cycle would be, you would take the unadjusted trial balance, then you would have to make the adjusting entries. Okay, and then from the general ledger, you have the adjusted trial balance. And then from that, you prepare the financial statements. So the adjusted trial balance is going to be the basis for preparing the financial statements. Now, when you look at, again, when you look at the T accounts, so for example, let's go back to the illustration we had before. On the unadjusted trial balance, let's go to our illustration that we had earlier. On the unadjusted trial balance, the unearned subscription revenue was how much? It was $480. When we made the adjustment and we flow it through, on the adjusted trial balance, unearned revenue is $200. So the process of making the adjusting entries, the end process of making the adjusting entries is to be sure that the accounts are properly stated on the balance sheet. So right now, when you prepare a balance sheet from the adjusted trial balance, you're going to use unearned revenue of $200 and not $480. So the correct amount that appears on the balance sheet is going to be the $200,000. That's the corrected balance, and that's the purpose of the adjusting entries. Now, again, there's not much to, add to that. Just tells you again in the module, it just tells you again that when you do a trial balance, you have to be sure to, again, you list all the accounts and their debits and credit columns. And of course, the balances are used to prepare the financial statements. So everything is in the debit and credit column. You're also going to be thinking about the way it looks. I mean, that's the way, of course, any trial balance appears, but the adjusted trial balance, of course, would have all of the corrected numbers, and that's all a trial balance looks like. I did have some questions on, whether or not depreciation has separate accumulated depreciation accounts. Just a note on the accumulated depreciation. You cannot separate out the accumulated depreciation from the building you cannot really separate, although it's an individual account, on the financial statements, they have to be recorded or at least reported together. So the building has to be reported with its contra account, and the furniture and fixtures have to be reported with the contra account as well. And then finally, of course, again, this is a good summary. I know I had questions today about overstatement and understatement. Make sure you're very familiar with the 4 types of adjustments and how they affect the financial statement. So this particular slide, in general, I think, is a good summary, but this, again, specifically, it's something that you should be aware of. You need to know, we talked about why accounts would be over and understated. And of course, the 4 types of adjustments. The first category, prepaids and unearned, are deferred or deferrals. And of course, the accrued revenues and expenses are accruals. And how do prepaids and unearned come about? Advanced cash transactions. When you have a prepaid expense or a deferred expense, you pay cash first. When you have a deferred or an unearned revenue, you receive cash in advance. On top of that, these adjustments have to be made with respect to existing accounts. So you have to go in and look at account balances, where accruals are very different. Accruals are transactions that were not recorded. So the difference with an accrual is that you have to create the accounts, or at least make the entry from zero basis. You've got nothing there. Whereas when you have deferrals, the trick with deferrals, whether it's an unearned or a prepaid, is you have an existing account, and that account has to be adjusted. With an unearned revenue, as we saw, you ought to adjust the subscription revenue from $480 to $200. If you look at office supplies, we had that example where there was a $6,000 balance. You ought to adjust it from $6,000 down to $1,000. So when you have deferrals, there are existing balances that you have to examine, and again, make sure you know where you are and where you want to be. Accruals are much different. Accruals are much different, where that would mean that you have to look at a bill, or you'd have to look at a statement. So you would get a bank statement that said you earned revenue of $1,000 this month, something you haven't seen before, something you were not aware of, and then you have to debit the receivable for interest and credit the revenue. So accruals are unrecorded, and you have to wait till you get a document or you get information. The same thing's true with an accrued expense. You don't have the information until you get a utility bill or someone sends you an invoice. So that's the difference. So just be aware that when you're looking at the prepaids and the unearned revenues, those accounts require that you look at a balance in an existing account, okay? Because there was a cash transaction before the event took place. All right, so any other questions on adjusting entries before we go into 4? Okay. All right, so let's go into, let me just close this down. Just give me a second. All right, so this chapter will complete the accounting cycle. It's going to take us through adjusting entries into the adjusted trial balance and then into the financial statements. Another important part of this chapter is going to be the fact that we need to think about closing temporary accounts. Way back a couple of weeks ago, about a month ago, I think I said that balance sheet accounts are permanent, income statement accounts are temporary. So what you're going to need to do is you'll have to close out revenue and expense accounts, and of course dividends are temporary as well. So income statement accounts and dividends are temporary accounts. Balance sheet accounts are permanent. Yeah. Yep, that's an appendix. There's an appendix and the worksheets. that are there we're going to cover right now in 4. The same worksheets we're going to cover in Chapter 4. So whatever you see in 3 on those worksheets, that we'll pick up in 4 as well, and we're not going to cover the appendix. There are some questions about the appendix and the assignments, but we're not going to cover that here. We're going to see that again in Chapter 4. Okay, so again, to introduce the topic, you've got a couple of issues. One, the adjusted trial balance into the financial statements, and again, we will see the use of worksheets. And the other issue is closing. Everyone needs to be very clear that when you have an income statement account, dividend accounts, these are temporary in nature. Balance sheet accounts are permanent, and they carry over period after period. So in order to measure revenue for the month of October, I need, at the end of September, at the end of this month, I need to make sure that revenues go to 0. I have to make sure that I close out or zero out expenses so that I start counting revenues separately for each month or for each accounting period. So we'll see that through in this chapter. So that's the, I guess, the objectives here. Okay. Now, when we prepare financial statements, we're going to find out that, again, I mentioned that the process is after we have journalized the adjusting entries, we post them to the ledger, the adjusted trial balance is going to be prepared. That is going to be taking information from that adjusted trial balance. And again, when we look, same adjusted trial balance we saw before. What we're going to do now is we're going to take a look one more time. I'm just going to review this with you, and that's what this book does. It tends to review a lot. We're going to review the notion of taking the accounts from the adjusted trial balance, making sure they go into the correct financial statements, and also try to understand the fact that the statements articulate. So again, the order in which we prepare the financials will be the income statement, then the statement of retained earnings, and then the balance sheet. Someone asked me today during office hours about cash flow. We're not going to touch cash flow again for quite a while. So our 3 basic financials will be income, retained earnings, and then the balance sheet. And again, the notion is, again, articulation. The fact that we link financial statements together, the fact that income from the income statement goes into the statement of retained earnings, that is known as articulation. And then, of course, the retained earnings that is coming off of the retained earnings statement is needed to balance the balance sheet. What you're going to find out as you start going through more and more problems is that when you think about the retained earnings account on a trial balance, that number is not what goes on the balance sheet. What goes on the balance sheet has to be the retained earnings that you create or you develop from the statement of retained earnings. Okay, so from the statement of retained earnings, you have to think about the fact that the income comes from the income statement, the balance of retained earnings goes into the balance sheet. So let's see that again just to review. So if we take a look at this adjusted trial balance, this is after all of the adjusting journal entries were journalized and posted. The income statement accounts, of course, would include the service revenue and all of your expenses. Another question that came up was whether or not the depreciation would be separate on each asset account, and that is in fact correct. So the income statement would be separate or would have separate depreciation accounts for furniture and for building and for whatever other asset you may have. So now, taking it from the adjusted trial balance into the financial statements, when you look at, again, when you look at a income statement, first the title, the name of the company, then the name of the statement, and notice again, this is a flow statement. So it says for the 2 months ended, and this is going to become important when we think about the idea of closing entries. These revenues and expenses are only for a 2-month period, and they would not affect the following period. They're not cumulative, so only for the 2 months. And then, of course, revenues minus expenses would give you the net income for the period. Now, that information is going to go into the statement of retained earnings. And I'm just reviewing, so I know we did this already, but I just want to be sure that we're clear so that the net income for the period is going to go into the statement of retained earnings. And in the statement of retained earnings, once again, you should have a beginning balance. Typically, it's been 0 for us right now, a beginning balance plus net income minus dividends. Dividends, again, are not expenses. They are a distribution of retained earnings or a distribution of income out to shareholders. So now, if you needed to take the next step, which is the statement of retained earnings, and again, as I said, you really can't, these examples might be too simple, and I had a very good question from someone here about the fact that retained earnings would be really cumulative. So remember that the balance of retained earnings for this particular period, which is the ending balance, becomes the beginning balance of the next period. And we'll see that as we start moving through the course. So retained earnings at the beginning of the 2-month period happen to be 0. And this seems to be an assumption that they make in the book quite often. Then net income for the 2 months comes from the income statement, so we should see that here. So the income is coming off of the income statement into the statement of retained earnings, and that's going to be your point of articulation. And the retained earnings for the period is going to go into the balance sheet. Now, the balance sheet that we'll see will be unclassified, and we'll talk about that in a second. Before I get there, any questions on taking I think it's pretty simple, but I just want to be sure you're taking information from the adjusted trial balance. Now, again, all of these accounts have been adjusted. So, for example, the supplies expense here would have been adjusted for the count of supplies on hand. We talked about that earlier, about counting the supplies that remain and making sure that we have the proper expense. Okay, so here's the balance sheet. I'm sorry, in the dividends, rather. So the dividends, again, would come also in the statement of retained earnings. Okay, we're going to get to the balance sheet in a second. All right, so any questions on the statement of retained earnings? Yes? No, I don't think so. Yeah. Do you have them with you? Okay, yeah. All right, so try to, especially the small, you don't have to print all of them, I guess, but if you print out the smaller versions of them, they're all up on Blackboard. Okay. All right, any other questions? All right, so now we're going to do the balance sheet, and we're going to add something to this right now. When you look at the balance sheet can be reported in a couple of different ways. So when we look at the balance sheet, we have 2 formats. So the 2 formats that we have for reporting the balance sheet would be a report form or an account form. And then within those 2, they can either be classified or unclassified. Now, when you think about the report form versus the account form, it's just a matter of where and or how you list the assets, liabilities, and equity. So that if you do a report form, and I'll show you some examples in a second, but, or at least one example. So if you have what is known as a report form, assets are listed above the liabilities and stockholders' equity. And again, this is not anything difficult, but it's just a matter of information. This is the most commonly used approach. So the report form is the most commonly used approach. When you have the account form, it's actually going to look almost like a T account. So the format is that you would have assets on the left side and you'd have liabilities and equity on the right. So it almost looks like a T account. So if you were asked to prepare a balance sheet in the report form, assets come first, followed by liabilities and stockholders' equity. If you were asked to prepare it in the account form, you would have to put the assets on the left, liabilities and stockholders' equity on the right side. So it's just a matter of reporting format. Now, within those two, and again, nothing difficult, but within those two, there is either a classified or an unclassified set of financial statements. And this is something we need to get into more detail, but the classification depends on a couple of things. One, the type of assets you have, and the time frame in which those assets are going to be used up. The type of liabilities you have, and the time frame in which the liabilities are going to be paid. And this is where we get our classification as either current or non-current. So the balance sheet could show, again, the assets as either current or non-current. Liabilities could be shown as current or non-current as well. Now, I'm going to go to, let me move up, and I know I'm sorry if this is a little bit blurry for some of you don't have the slide, but if you move over up to the slide here, actually, let me get the other one. I wanted to show you how the, okay. This is where I'm showing you a couple of things. One, this is showing you the transfer or the articulation of the retained earnings account into the balance sheet. Now, this is what you would consider to be an unclassified balance sheet, and it is going to be what we would look at as a report form. It's a report form where the assets are stacked above the liabilities and the stockholders' equity. So this is going to be a report form, but it's unclassified. A couple of things to note, again, when this is another question that came up during office hours. If you look at the furniture and fixtures, and again, I apologize for the size, but this is what the publishers provided. When you look at the furniture and fixtures and the building, notice that you cannot separate the accumulated depreciation from the related account. They have to be reported together. So furniture and fixtures, or furniture less accumulated depreciation, and the building less the accumulated depreciation. That's the way it has to be reported, and the net amount is called the net book value. So for example, if you have furniture of $18,000 and the accumulated depreciation is 3, that is $17,700. That is known as the net book value of the asset. The net book value of the asset is the cost minus the accumulated depreciation. So on this particular balance sheet, when you on the balance sheet, this 18,000, sorry about that, the 18,000 is the cost of the asset. There was a $300 accumulated depreciation. Now, although the term isn't used, this is called the net book value. So that's called the net book value of the asset. Now again, this is sometimes called the accumulated depreciation. It's sometimes called the contra asset account. It's called the contra asset account. And it cannot be separated on the balance sheet, and they have to always be treated as a single unit. So again, this question came up today. Just make sure you know that although it does have a credit balance, if you go back to the trial balance, you go back to the balance sheet, and you see it as a negative balance, it is going to still be on the asset side of the balance sheet. It's still on the asset side of the balance sheet. So if we looked at the accounts separately, that's the way they would appear in the ledger. You have furniture of $18,000. That's the cost. The accumulated depreciation would be on the credit side. It is not a liability, but it still has a credit balance, and its normal balance is still a credit. And of course, every year or every month, if you're taking $300 per period, you would just keep accumulating that in that same account. All right, so are there any questions about reporting on the balance sheet for items with contra accounts? Yeah, Dan.
For depreciation expense.
Right.
Credit 300,
Debit 300, right. So in the adjusting entry, so the question is, with respect to, let's say this was the first year's depreciation, the question was, what would the adjusting entry had been, or what was the adjusting entry to get to this point on the adjusted trial balance? So you would have had, if this was an adjusting entry, you would have had a debit to depreciation expense and a credit to the accumulated.
Don't you always have to do like both of them if you do one? Aren't they both together?
What do you mean by the? Let me get the question again. Yeah.
For depreciation expense and accumulated.
Right.
Don't you gotta, if you do one, don't you gotta do the other since they're both together?
Well, you do. The entry would look like this. So that's how the journal entry would look. So you have to do them together. Right. So the entry would have to be a debit to depreciation expense and a credit to the accumulated. Okay. All right, good question. Any other questions? Okay. All right. So now going back, so that's, again, the adjusted trial balance. So the concept of articulation, again, is income into, by the way, I'm still here. I don't know if you can, thank you. Might not have seen me with the yellow shirt. You've got income statement into the statement of retained earnings and into the balance sheet. Now, that's the account, that's the report form. If this was in the account form, the assets would have been, we'll see that a little bit later, assets would be on the left, liabilities and equity on the right. The form doesn't matter, the numbers stay the same, the concepts stay the same. Now, the issue I think that you need a little bit more time on is the classified balance sheet. What we're doing now is when we prepare a balance sheet, you're now going to have to worry about the classification of assets, classification of liabilities, and equity. We're going to group them now, and the primary concept here is to match maturities. So when you look at the slide, you'll see that these are typical categories on the balance sheet. You've got current assets, long-term investments, property, plant, and equipment, and intangibles, which we will define today. And then you've got your current liabilities and your long-term liabilities and stockholders' equity. The current liabilities are liabilities that you expect to be used up how long? Within 1 year, or we'll define it in a second, formally, it's 1 year or operating cycle, whichever is longer. Now again, these are little nuances, concepts that, in a multiple choice question, you're throwing away, 2 points, 5 points, whatever it is. It's not 1 year. It is based on an operating cycle concept that we'll define in a minute. Current liabilities are typically liabilities that you owe within a year operating cycle. We'll talk about that again. Yeah. Yeah, operating cycle could be more than a year, and that's the exact point, and you'd still be current. Yeah. So if I asked you a question, true or false, is, an asset I'm going to use up in 18 months, is it current or non-current? Well, if you say false, you might be right, but it depends on the operating cycle. If the operating cycle is longer than a year, it's still current. Okay, and we'll talk about that in a minute. Now, I mentioned the concept about matching maturities. Matching maturities. Why do you need to know what assets are current in that diagram? Why would you need to know that? You're looking at, again, you're not an accountant, you're a credit analyst, or you're, a financial analyst, and you want to look at this company's ability to take out additional debt. Say it again, please. No, I'm talking about the current assets. Why would you need to know the composition and the amount of those current assets? Yeah, Tom. Well, net worth is equity. Yep. Right. So what I need to know, so the question was, if you weren't, let me get the answer also. The question was, why do you need to know what assets are current? Well, if you have current liabilities coming due, so you got credit card bills coming due in 15 days. October 15th, you get a ton of credit card bills. You get, Visa, MasterCard. You get your cell phone bill. You need to be sure you got enough cash to pay them off within that period. And that's what we mean by matching maturity. So when you classify a balance sheet, it's not just something for you to memorize. It's not just something for you to just write on a statement. It is designed to be sure that the reader of the financial statements, whether it's in finance, whether you're in marketing, whatever the case might be, or in management, you want to be sure that this company has enough assets that are going to be converted into cash on time to pay off those liabilities. So that's why, and someone asked a question today in another part of, I guess this morning, someone came to see me, and question was liquidity. Why do we worry about liquidity? What if all those current assets are prepaid expenses or inventory? What good is that going to do you to pay off your bills? Well, you have to sell off the inventory, and how are you going to sell prepaid rent? So it not only depends on whether they're current or not, it depends on whether or not you could sell them quickly enough to pay off those liabilities. So the classifications are tied to the company's ability to pay off its debt when it's due. And we don't really worry, too much right now about long-term liabilities. We'll get to that, when the time comes. But right now, this month, I'm worried about current assets and current liabilities. Then next month comes along, and the long-term liabilities get closer to becoming due. I have to worry about making those payments as well. Okay. All right. Now, when we get back to this concept, remember that we've got the notion of liquidity. So that's why assets are listed in the order of liquidity. And liquidity is the ability to convert an asset into cash with minimal risk of loss. Current assets, of course, are more liquid than the non-current assets. Now, by definition, this is important because we're going to tell you that current assets are cash and other resources that are reasonably expected to be realized in cash, used up, or consumed within 1 year or operating cycle, whichever is longer. Now, the operating cycle concept is important because there are a lot of businesses. So I guess we had a question about, do some businesses have operating cycles that are greater than a year? And the answer is yes. And I'll show you an operating cycle in a minute, and I'll also show you what possibilities or what types of businesses you could have. So you know that current assets would include cash, receivables, supplies, inventory, and prepaid expenses. And those are pretty much in the order of liquidity, because I can, obviously, cash I have now. Receivables, I could sell them much easier than inventory. There's a lot of businesses that are in place to sell inventory, or to sell receivables. Then the inventory is the next most liquid. And then, of course, you've got prepaid expenses. It's not easy to sell a prepaid expense because if you prepay rent, unless you could sublease that, you can't really sell it. If you prepaid insurance, that's your policy, you can't really sell it. So we list them in the order of liquidity. Now, what is the operating cycle? Well, if you look at the diagram, that is a typical operating cycle for a... Could you do me a favor? Yo, man, hack backward talking. Yo, just do me a favor. Just talk lower or talk outside, all right? Because it's getting like a little too loud. All right, thank you. All right, so if you look at the operating cycle, you would have cash being invested to buy inventory. If you don't have enough cash to pay for all the inventory, you've got accounts payable. That accounts payable is used to buy inventory. Then you sell the inventory for credit. You got accounts receivable, and then you collect it. So you're going from cash to cash. So you put cash in a business, and this is important for management as well. You put cash in your business. You have trade payables to help you finance inventory. Then you sell that inventory. You have receivables. You got to collect, and then you got cash back. Yep. Yeah, I mean, yeah, any stock market crash, any downturn in any economy or any business is caused by what? Inability to sell inventory and inability to collect receivables. So if you look at the diagram carefully, I mean, if you look at it carefully, basically, let me see if I can put this up on the screen and show you. There you go. All right. So if you look at that cycle, and any delay in selling that inventory is obsolete, you don't have your cash. And this is what I meant the very first day we were in class talking about the applications of accounting for management or for supply chain. I mean, if you can't move this inventory, you got a problem. If the inventory doesn't come on time, you also have a problem. But if you invested cash in that inventory and you owe this money and you can't sell it, that's one problem. Here, if you can't collect the receivables, you got another problem because what's going to happen next? Somebody's going to be asked to be paid back, right? So when you look at this cycle, what we hope happens is that this cycle turns around a couple of times per year. So you got cash going. First thing that happens when you collect the cash, you got to pay off your trade payables. The next thing that happens is if you have any free cash, you put it in investments. And then, of course, the third thing is you put it back in the cycle. But any delay in that cycle would involve borrowing. You'd have to borrow money, right? So, if you've got people that are, waiting to be paid on those accounts payable, and that cash is not coming in, you're going to have to borrow on a line of credit. So, again, the operating cycle is a critical concept that, again, you want to make sure that the cash comes in time to pay off those liabilities. And again, the idea of the cycle that, how liquid are these receivables? How liquid is the inventory? If it's obsolete, you're going to have trouble. You have to mark it down. You may have to reduce your price. You're in marketing. You can't sell a product. How far do you reduce the price down? And one of the things that none of us, and even sometimes I have to think twice about this, what a lot of people don't do is mark the price down. So I don't want to sell it for that. Gee, I paid $1,000 for that item. I can't sell it for $400. Well, if you don't sell it for $400, you have nothing. So you can't worry about the $1,000. That's a sunk cost. Whatever you paid for that inventory is gone. So you have to think about getting enough cash to keep the business going. So if you can't sell the inventory, it's going to be obsolete, and you may have to mark it down and sell it for a lower price. So these are the business decisions you need to make with that cycle. Now, you would think that a company's got multiple cycles per year. Most companies are going to run several different accounting cycles per year. And we had a question, which was a good point. What about a company that has an operating cycle that takes more than 1 year? Any examples? Could you think of anything? Yeah, no, that can happen. You know, your receivable could be paid next year. But what type of business would be structured so that it takes more than a year to collect? You know? Yeah, well, sometimes when you're stuck with inventory, yeah. Yeah, it's a perfect example. When you have the lumber industry, right? By the time you plant and and tree, cut it down and everything, I'm thinking more about anything that you're not supposed to do. Smoke and drink. Cigarettes, tobacco. If you look at Brown & Williamson Tobacco Company or P. Lorillard or any manufacturer of cigarettes, they're going to say we have tobacco in inventory that we're not going to use for 18 months, and it's still a current asset. So for those of you that have taken accounting before and have thought that current assets are 12 months or 1 year, you're going to be wrong in a lot of cases. Also, alcohol. You have to age wine, right? It takes a long time. So sometimes you'll have cycles that take more than one accounting period. All right, now, we're going to find out that although we don't cover a lot of these financial ratios, we have them in the textbook, we're not covering them extensively, but if you take a course in finance, for example, you'll be able to measure a company's operating cycle. You'll be able to estimate how long it takes them to sell on average. You're going to be able to estimate how long it takes them to collect those receivables. Actually, if you go online, if you're interested in buying a car and you're not sure which car to buy, where are you going to get your best deal? You'll get your best deal for the cars or the manufacturers that have the most stock on the lot. And you could find out how long it takes to sell a certain car. So if you wanted to buy, a Camry versus a Honda Accord, you could find out the average stock that a dealer carries, and the lower that stock, that means the faster they turn them over and the less likely they're going to discount those cars. And that is available online. So dealer stock or how much stock they have is available. So you could estimate that. A lot of companies do that for you, and it would let you know whether or not the company is able to turn over its inventory quickly. All right, so that's what we mean by an operating cycle. Now, those are current assets. Some of the long-term assets, long-term investments, and by the way, this is really the definition of a long-term investment. It's just the opposite, or a long-term asset. It's going to be an asset that you don't expect to collect or convert into cash within a 1-year period of operating cycle, whichever is longer. Long-term assets include investments. They also include tangible fixed assets like property, plant, and equipment. They're also long-term. And you also have, on the next page, you also have intangible assets. Intangible assets are going to be rights that you acquire. They do not have any physical substance, but they have value because of the rights that they confer on the holder. So if you have a franchise, all you've got is a piece of paper that allows you to sell the product. If you have a patent, it gives you the right to manufacture a product. If you have a copyright, it gives you the right to sell a book or a musical or an artistic work. So intangibles like trademarks, trade names, patents, these are intangible values. They don't have physical substance, but they have value to you because of the rights that they confer. Okay. Now, we mentioned that we saw the report form. Here's an account form, just to make sure we see that. An account form that is classified. So this is an account form. It has the assets on the left, liabilities and equity on the right. More importantly, it is classified. So notice it's got current assets, listed as cash, receivables, office supplies, prepaid rent. The long-term assets include plant assets like the furniture in the building. It's the same balance sheet we had before. That was in a report form and was not classified. This is classified now. Liabilities are first current and long-term. Current liabilities are accounts payable, notes payable, etc. Interest payable. Long-term liabilities include your notes payable. Then, of course, in the equity section, you always list the common stock before the retained earnings. So again, this is a report form, account form rather. It's got the assets on the left, liabilities and equity on the right. If it was the report form, they would be stacked. Now, just one last point. We have to think about what we mean by the current classification. Current liabilities, again, are just like current assets in terms of time. Liabilities, of course, as I said, are listed in the order of maturity. Current come first, then long-term. The current liabilities, as we would think, again, it's a 1 year operating cycle, whichever is longer. So you have 1 year or one operating cycle, whichever is longer. And the long-term liabilities, of course, would be a period greater than 1 year, obligations due in a period longer than 1 year or operating cycle. Long-term debt, of course, is an example of a long-term liability. Question? It's okay, thanks. Okay, got it. Okay. All right, now, just again, some more definitions. Stockholders' equity. Don't forget, in the stockholders' equity section, we're looking more at corporations, but at the beginning, the very first day we were here, we looked at different forms of businesses. So just by way of review, as well as to be sure that we're familiar with different types of businesses, for a corporation, stockholders' equity is the term that we use, but for partnerships and sole proprietorships, we use the term capital. So that when we think about the different types of equity or capital, it depends on the type of business. So for a corporation, okay, it's called stockholders' equity. So for a sole proprietorship, it's called capital. You'd usually put the owner's name. And it's the same thing. Capital is going to be exactly the same as the stockholders' equity. And then for a partnership, each partner has a separate capital account. So each partner has a separate capital account. Now, another difference. All right, what about distributions? Okay, so distributions. What is a distribution to a stockholder called in a corporation? Dividend. So when you distribute profit or distribute earnings out to a stockholder, it is called a dividend. The same concept, but a different term. If you have a distribution to either an owner or a partner, it's called a withdrawal. So the term withdrawal is going to be used for distributions to owners of capital in either a sole proprietor or a partnership. Now, our focus is, of course, going to be on corporations, but occasionally, from time to time, we'll come back to the other forms of business. Yes?
Is LLC considered corporation?
Yep. Limited liability partnerships are still partnerships. You have limited liability corporations, LLC, are corporations where you have shareholders as well. Yes? Yes. What happens is that, and you have to remember, and this is important, for the exam now, don't forget, those questions go back to chapter 1. So this is a very good question. The idea of having a partnership or a sole proprietorship is based on the business entity concept, not anything with respect to the law. So as far as the law is concerned, for tax purposes, it doesn't look like you took money out of the business and paid another individual, yourself, or a partner. As far as the government is concerned, or as far as the law is concerned, it's a single entity. But from an accounting perspective, yes. From an accounting perspective, we treat it as if it is a distribution to a outside person. Okay? But it's clearly true it's absolutely true for corporations that the dividend is going to an outside individual. Okay? And the question you asked before about limited liability corporations and partnerships, those are pretty much tax structures. So it's something we don't really get into here, but those are like tax structures. Okay? All right, now. So to summarize, okay, so here's a summary. And again, you need to know the definition. So you have current assets, assets expected to be used up within 1 year operating cycle, whichever is longer. You have your long-term investments. Notice again here with the long-term investments, you're investing in stocks and bonds. Are these your own, or are they stocks and bonds of other companies? Other companies. So you're holding shares of other companies. Then, of course, we have property, plant, and equipment, and then the intangibles. The long-term would be assets that would not be used up within 1 year. On the liability side, again, assets listed in order of liquidity. The liability side listed in order of maturity and current liabilities. By the way, how do you get a notes payable up there? Got about 4 minutes. How do you get, take a look at those current liabilities. What if on the exam I gave you a question and I said notes payable are long-term or current? Do you know? Can they be both? Well, they could be both. And how could they be both? You could have a note that's a 30-day note. You could have a 6-month note. You don't have to have a note that goes beyond 1 year. So again, they're listed in order of maturity, current liabilities first, and then the long-term, and then, of course, your stockholders' equity. All right, now, let's think about one or two things. So we've already got through this first cycle. Let me remind you again, or at least first learning module, let me remind you again about the exam. The exam is Tuesday. You have to be here on time. If you're late, I can't give you extra time because there's another class that comes in. The exam will be multiple choice. It will have computations as well as theory. So you have to make sure you know all the concepts that we've talked about, anything we started from the first day we were here until today. I also mentioned again, you have to be aware that even if something is not necessarily on one of these slides, I know sometimes, I never used PowerPoint before because I know people think that you're reading off them, but I hope, saying things beyond the slides, and if I did say something beyond the slide, you're responsible for that as well. Topic-wise, You like that? That's my style. All right. All right, now I just want to make sure you know. Make sure that you're prepared to do journal entries or understand how to do journal entries. So what I would do, for instance, is I would take let's say I took one of the problems you had for homework. I could take one of those problems and create a multiple choice question out of it. So I could give you a series of data. I can give you financial statements. I can give you an income statement. I can give you a trial balance. And I could say, based on this set of financial statements, answer the following questions. Answer the following 4 questions. What is the adjusting entry for supplies? A, B, C, D. What is the adjusting entry for unearned revenue? So I can take one of those problems and actually create them or build them into multiple choice. So you won't have any true false, but they'll all be multiple choice. How do you study for it? Make sure you go through the examples we did in class. Make sure you look at the multiple choice questions that are at the end of each of the modules, and make sure you look at the homework. And that should get you through. Okay, if you have any questions, I'll just shut down here and then we'll go outside.